Hey everybody, welcome back to another episode of Portfolio Talks. I am your co-host Tyson Nagasaka here with Mike Lloyd of the HomeHappy team. We're missing Vishal today, so it's just us dudes.
Hey, everybody. Welcome.
Yeah, how you doing, Mike?
Great, great. How about you?
Fantastic, man. I can't believe we are in as of filming, this is end of April, and I'm still thinking, man, we just finished quarter one, and like we're done April, and this year's flying by.
Super fast. Yeah.
So today we wanted to talk a little bit about some of the differences between the characters that clients come across and some of the questions that we get because you get them all the time, I get them all the time, and from my point of view, I wanted to ask you like what's the difference between a client going to their bank to get a mortgage versus dealing with a seasoned professional that's an independent mortgage broker. What do you think about those
Yeah,
kind of
it's a
scenarios?
it's a great great thing to discuss because I was that person working at a credit union and sold credit union products. And there's nothing wrong with that, but the fact is I didn't like that I could only give my clients one product, like whatever we had at the credit union, whether I knew something else was better down the road or not. And eventually that got to me, so I became independent, and I like it so much better, because I have that flexibility and I can give the clients the objective advice they need. And that sounds really kind of smarmy, but objective advice is so hard to find. And you got to, just like the media and other things we're learning about, like you can't trust everything you get told. And sadly, or not, I mean, if a person has a bank brand on their card, they're selling that product, period. They're not going to tell you, oh, there's something better somewhere else. And the banks coach them and work with them to become great at their job. But the fact is, at the end of the day, it comes down to their products. And generally, what they have is rate. That's what they try to sell you on. To me, it's so much more important to have a full strategy, a plan. Where do you want to be in 25 years? Where do you want to be when you retire? What about your kids? I mean, there's these big picture stuff that we have to talk about. Most of those don't get talked about when you talk to one of those people. Yeah, so in general, I feel like we are better positioned to look after our clients' best interests, um, and long term ways to manage their mortgage and get them to pay less interest overall. Rate's important, but it's not everything. And banks will also push products that have weird details inside them that you may not know, and that's a big piece that's really important to know. Is they're not all the same. I know of mortgages that are locked in. You literally cannot get out of that mortgage unless you sell your property. And in this day and age, you think that didn't exist anymore, but it does. And they also do tied selling, so you have to take
Yeah.
out and move your banking and do all those sorts of things. So lots to talk about, I'm sure, from the mortgage side, but also from the financial planning side. I mean, when you see a bank financial planner, it's a different situation than what you're dealing with, right? I mean, what you do.
Yeah, it really is. Um, there's a lot of good people that come out of that system, myself included. I also came from the credit union and then went into several different financial planning companies to come out an independent financial advisor. It took time, but I think some of the differences that we see there is number one is it's never one relationship to guide you through multiple phases when you're dealing with a company owned financial advisor. They're usually an insurance guy or an investment guy, and they don't do holistic planning where they're also going to look at your debt. They're also going to look at, potential retirement and estate planning. They're going to look at your business and your personal stuff. They're going to refer you to different people. And so you're constantly restarting the process and there's no continuity within your plan. The other part that's unfortunate is those people who work for banks and credit unions, they want to get promoted. So they're there for 6 months, 9 months, a year, and then they're on to the next role because they want to make more money too. And so then you, as the client, you're restarting the relationship every year or year and a half. And I had a friend that worked at a bank in in the North Shore, and he had 5,000 clients because that's how many clients were investment clients at his branch. And it's like, good luck getting a phone call, getting personalized service, having follow up. And then like how many years would it take for you to call each one of those clients once and have a meeting? It would take
Yeah.
forever.
Yeah.
Yeah. So there's a lot of like micro reasons why it's a good starting place, but it may not be where you want to be long term once you're established, once you have really defined needs, and especially if you have sophisticated problems.
Yeah, and I mean, at the end of the day, they're gonna sell the bank's product over everything else. Is
Yeah,
that necessarily the best thing for you? Well, I don't think that matters in that equation. Like, unfortunately, like the bank mutual fund or the bank insurance or whatever it is. I mean, those are huge companies and they have a lot of different products, but at the end of the day, doesn't mean it's the best one for you in your situation. And
that's exactly right. Yeah.
yeah, and
Eh,
I don't want it to sound negative because we're not trying to be negative, but I think we're just trying to point out the reality of what you're getting. I mean, you don't go to a Tesla dealership and ask for a Nissan. You get a
that's right.
Tesla.
That's right. That's
um,
exactly it.
yeah,
We on our side of the industry, I mean, we call those people, they're manufacturers and distributors of the product, and so there's kind of that conflict of interest in that. You came to us and it's like, don't worry, we're going to find the best solution for you. It turns out the best solution is the product that I manufacture and I distribute, so here you go. And
yeah,
you're not allowed to look at outside opportunities or options, even though it might be, reduced premiums or more bells and whistles or more features, and might get you to your objective quicker, because it's not produced by that company. Those advisors aren't allowed to recommend it.
for sure. And I think one kind of false thought out there is that if I have everything at one bank, I'll get better deals. And quite honestly, I think it's the opposite. I think the more products you have outside the bank, the more they're going to try and fight to give you a better. Because once you're in the bank, they don't give you the same deal. Like you're considered
That's right.
inside, so it's easy, and they just keep you there.
That's
Um,
right.
and I think that's a real misconception that a lot of clients have that, oh, I've got my checking account, I've got my mortgage, I've got my car loan and my line of credit and my home insurance and my mutual funds and like you don't have a negotiating position then because everything's there and they know that it's harder for you to leave than it is to stay. So
Yeah,
uh that's an important thing to understand too, I think.
it really is. And that's a funny point, because on the investment side of the industry, we've battled with clients a few times where they want to pull all of their portfolio and their strategy and move it to, the bank or the credit union, because they said they're going to give them 25 basis points on their mortgage, or something
Yeah.
like that. And it used to be that those were, separated like church and state, and you weren't supposed to be able to say, hey, if you bring in, your investment business or your banking business, then on the lending business we're going to give you a little bit of a better rate. But it doesn't seem to stop anybody. I don't think
No.
there's no rules attached to that. And sometimes they're not better off, because again, they fall into that loop of, hey, you got an investment advisor, we get you set up, and then that investment advisor moves on in a year or two or three.
Yeah. Yeah, and that's the thing, like once you get a relationship going, don't count on it lasting because they're going to be gone, and that's sort of sad for a lot of people, I think. So, yeah, I don't want it to sound like a negative. I think we're just trying to point out that the reality is you're not going to be dealing with the same person for very long, and while it might seem like you're getting a deal at the time, it's like getting free winter tires when you buy your car or something. It's if you never drive in the snow, it doesn't really affect you. So I find for a lot of those situations that they'll do some kind of deal. Like even they always sell a 5-year fixed rate. That's what banks sell, but 85% of Canadians break their mortgage in 38 months. That's the average in Canada. So it tells you it's not the right product probably for most people, and yet here they are selling it 99% of the time. So um, that's just one example. But I think yeah, overall, I think there's a lot to be said for having diversified investments and diversified banking because it allows you can even play them against each other and that's going to help you in the long run I think too. But the big thing obviously is just having the right advice and making sure it's objective. I don't think they can give you the same objective advice that you and I can, and that's really important. So.
Yeah. And do you think volume has something to do with that? So if the bank has a never ending line of people coming in the door to get a mortgage or to get a line of credit or whatever, do you think that they have the need or the ethical portion where they have to tell you, hey, this isn't right for you, or maybe you shouldn't do this? Or do they just approve or make a deal and then move on to the next client?
Yeah, they don't. I don't think they look at that generally. I mean, in quotations they will, but they don't really pay much attention to it. And it's yeah, it's not the best thing for the client, and that's to me should be the number one thing is what's the best thing for this client. I mean, I've told clients not to go ahead with a mortgage we were looking at because they're better off to do this or do that, and maybe they already have a HELOC in place that makes sense or whatever. And um, I'd much rather tell you the truth and not get paid because I think long term, I think you'll respect me more, and I want to build my business for the long term. I'm not here to get promoted and leave in a couple of months because I put enough business in.
Yeah,
Uh, so that's to me, I think that's the biggest difference between us and them. Um,
yeah, I agree. I've made a lot of other people money
yeah,
by giving honest advice,
yeah,
like don't do it, stay where you are, or do this instead. And you hope that they when they leave that they actually follow through on your advice. But sometimes it makes a big difference to like not just write the sale.
yeah, absolutely.
Awesome. Well, what do you think about with the like on my side, the industry's changing a little bit in the way that we're regulated and how we are um, supposed to disclose and make, um, how do I want to say this? Well, let's just go on disclosure first. We're supposed to be disclosing how fees are done, how we get compensated, if there's conflicts of interest. Like we're overly regulated on the investment side about how we're supposed to disclose, and it's really like it makes it not fun to take on a whole bunch of clients. But what do you think? Is there anything like that that's happening on the mortgage side that brokers are like, this is a change and this is a lot of like
Oh yeah,
regulatory stuff?
the bureaucracies that control us federally and provincially are both trying to do the same thing. Lots of paperwork to make everybody feel protected, even though I don't think it really protects the majority of people. We have to do disclosures, conflicts of interest, all that kind of thing. Um, but what's sad is I think that these rules are made for the 1 or 2% of the population, and so then 98 or 99% have to jump through the hoops every time, even though it doesn't apply to them or never will. And that's kind of sad. I think it's a sad state for our whole society that we are like that. But yes, tons of regulations come through. The world has changed a lot, and since I've been a broker in 1999, we didn't have any of that, and now we have a whole bunch of it. So I think it's come from the investment side. A lot of it did come start there, and now it's coming through. But what's funny is bank people don't have to go through the same stuff. They have a different rule, and that doesn't seem entirely fair either. And it's funny how many mortgage sales force we call them. They're basically bank mortgage people. Will call themselves brokers, and they aren't really
That's right.
brokers because they don't shop the market. They just talk to their bank, and then they do it through them.
Yep.
So what's interesting, even on deals that get turned down by the big banks, they all have places they send those deals afterwards that gets brokered. If they can keep the client and keep them happy. But yeah, and so yes, regulation has definitely come in our world. I mean, literally, we have to do AML, which is anti-money laundering um, procedures. So if you're buying a place, the realtor now has to do it. I have to do it, and the lawyer has to do it. So that you're giving ID out 3 times, as opposed to when the lawyer used to just take it and we got a copy, which made sense, but doesn't make sense. So yeah, there's lots of those little things that are coming through that I understand the overriding principle, but I don't think it is effective at the people that build the rules aren't actually dealing with real life
Yeah.
clients.
They're
So
they're not attached to operations.
yeah, so
Yes. Yeah. Yeah. We experienced it on the investment side. The uh, the rules were actually made because the banks were saying, "Hey, if you sell the internal bank product, you're going to get compensated more than if you sell an external one." And
yeah,
so there's conflict of interest. So they came up with all of these rules that you have to show the client so many choices, and you have to explain why the one that you're doing is the best one. And then we find out about a year or 2 years later that the bank doesn't really have to do that. They had a workaround the whole time. So the rule was created because of their actions, and then they don't even have to follow the new rules. And so it's funny. It's more like something to complain about, but um, I think it is a good exercise for some lazy advisors that hey, you have to like actually put in some work. You have to like, like I don't want to say play the field, but you got to look at like what's available, and there might be better options out there for the client.
Sure. Yeah. And that's like I said, I mean, the 1 or 2 or 5% that are lazy or not doing their job very well, it's probably good. But for the majority of full-time professionals, uh, it just seems kind of unnecessary. But I don't think we're going to be able to turn it around anytime soon. So
No, I don't think so either. I don't think so either. So that's today's that's today's complaint session, and
yeah,
that's what happens when Vishal's not here.
that's right.
All right, I want to thank everybody for tuning in and listening. This is Mike and I talking about independent versus in-house advisors and brokers. Please feel free to like, share, and subscribe, comment, and we will comment back and let us know if there's an episode or a topic that you want us to talk about. Leave that below, and we would love to talk about that because that's what we do. We talk. Um, I'm
Absolutely.
Tyson with the portfolio planning team. This is Mike Lloyd with the HomeHappy team. Thank you, everybody, for tuning in.
Thanks, everybody.